Okay, this is for POS 201. Today, actually, this is going to be a two-part series. First part, we're going to talk about monetary policy and the relationship between commercial banks and the Federal Reserve and households. And in the second video, we're going to go over very briefly the difference between debt and deficits. But for this video, we're going to talk about some of the tools that the Federal Reserve uses to either help stimulate the economy or contract the economy when the economy is doing well. If the economy is doing well, that means unemployment is down. Let's just say it's like, for instance, currently it's at like 4.8 or 9%. But when we get down to full employment, which is considered like 5% or 5.5%, the Federal Reserve will likely would like to step in and drive interest rates up by decreasing the money supply. But let's just go over before we get into all that, let's just go over very quickly some of the tools that the Federal Reserve uses to aid or even contract the economy. Now, there's three tools that are used. Two of them aren't very common. One is very common. But first, we're going to start with one that isn't very common, and that's going to be the reserve requirement. And all commercial banks are required to keep, let's just say, a set amount that's dictated or governed by the Federal Reserve of, let's just say, of 20%. Federal Reserve says that all commercial banks have to keep at least 20% of their cash assets on the balance sheet of the Federal Reserve, and that money is going to be used to later on, as I'm going to explain, it's going to be used to encourage spending. So one of the things the Fed does with the reserve requirement is now they may want to increase spending, or they may want to decrease or decrease spending in the economy. And one of the ways they do that is, let's just say Bank of America has to keep 20% of its money, of its holdings, on the balance sheet of the Federal Reserve. One way to stimulate growth in the economy is the Fed may say to Bank of America, well, instead of having 20% of your money on our balance sheet, you're only required to have 10%. And what that does is that frees up some of that money that's held on the Fed's balance sheet, and it's now on it goes back to the banks, and the banks can use that money to lend. And most people want to borrow money for anything, for, let's just say, going to school, buying a house, buying a car, or any type of investment or consumption. So let's just look at it in the opposite way. Let's just say the Fed wanted to decrease the money supply. They wanted to contract policy. Let's just say the economy is doing really well, and let's just say they wanted to raise interest rates for borrowing, and they wanted to keep inflation down. One thing they might do is, let's just say, like I was saying before, let's just say the Bank of America has to leave 20% of its money on the balance sheet of the Federal Reserve. Well, now the Fed says, well, you're now required to leave 40% of your money on our balance sheet. So let's just give like an example figure. If the Fed was required to leave 20% of its holdings on the balance sheet of Federal Reserve, let's just say out of $1 billion, they have to leave $200 million on the balance sheet of the Federal Reserve. And if they decrease the reserve requirement, that would be 10%, so just $100 million on the balance sheet of the Federal Reserve. And if they wanted to drive up inflation, drive up interest rate and drive down inflation, the Federal Reserve might use the reserve requirement and say, well, now you, instead of leaving 20% on our balance sheet, you have to leave 40. So that would be, let's just say, out of $1 billion, that would be $400 million that banks would have to leave on the balance sheet of the Federal Reserve. So what that does is that's just less money that banks have to work with for consumption and investment, that they can loan out to businesses, or they can loan out to individuals or companies or what have you. So this is one of the measures that they use to increase and decrease the money supply by using the required reserve ratio, which means leaving a certain amount of money on the balance sheet for the Federal Reserve by increasing it or decreasing it. Now, that was just a very brief synopsis. We'll go over it more in depth on Class Wednesday. Now, The second method that the Fed uses is going to be open market operations. Now, unlike the reserve requirement, open market operations is a very commonly used method of injecting money into the economy or contracting the economy if the economy is doing very well. And before I get too far into that, I guess I should kind of explain what bonds are, what treasury bonds or bills are. In the next video, we're going to go over treasury bonds and bill a little bit more extensively. But for now, you can think of treasury bonds or bills as an IOU check that incur interest over a particular given period of time. Excuse me. So let's just say the Federal Reserve wants to expand policy. They want to expand the money supply. They want to increase the money supply. They want to encourage consumption and investment. What the Federal Reserve will do is they will buy treasury bonds that commercial banks are holding. Okay, so buying treasury bonds or buying commercial bonds or treasury bonds from the bank. Now, treasury bonds are an illiquid asset. Remember, they're just used to incur interest over time to generate more money until you're ready to they mature and you're ready to cash them in. But if the Federal Reserve buys them from commercial banks, banks that hold treasury bonds are trading an illiquid asset, meaning they're not money. So they're trading an illiquid asset for cash. Okay, so being that they're trading it for cash, they're giving up something that they can't liquidate in cash for money. So when commercial banks get money in exchange for bonds, in effect, that process increases the money supply. And what that does is, because there's more money, it does drive up inflation. But because money is more of a readily available asset in banks, interest rates for borrowing are low or down. It makes it much easier for consumers like you or me or businesses or even perhaps in some cases other banks to even borrow from. Okay, so remember, they're trading an illiquid asset. The Fed is buying commercial bonds or treasury bonds from commercial banks for cash. So banks get cash, Federal Reserve gets bonds. This way, the money supply is increased. This encourages loaning or investment and consumption for consumers and households. Now, also keep in mind, we're gonna go over this in just a second, but households can also purchase and sell bonds to commercial banks or the Federal Reserve as well. Now let's look at this in the opposite. Let's just say the unemployment rate is doing really well. Let's just say we're at full employment, which is at like 5.5% or something like that. And the economy seems to be moving along quite well. And the Federal Reserve, using open market operations, instead they want to contract the economy. One thing that they would do is instead of buying bonds from commercial banks, they would sell bonds. They would buy bonds from commercial. Sell bonds to commercial banks. So now the Fed is the partner that has the money, and the commercial banks have bonds that they can actually trade with. But in this case, the banks are going to be the ones that are going to be buying bonds from the Federal Reserve. So the banks are now trading liquidity or liquid cash in exchange for bonds that are going to mature over time. And by this process, it takes money out of the economy, or let's just say it takes money out of the money supply. There's less money that banks hold because they're buying illiquid assets. They're buying bonds and they're decreasing the money supply. So there's not enough cash to go around. So this, in effect, what this does is it does drive down inflation because there's less money, but it also drives up interest rates. Interest rates go up because by the very virtue that there is less money in the economy. Okay, there's less money to go around. So banks, when they lend money out, being that there is less money to go around, they're more apt to charge a higher interest rate. So in a snapshot, that would be open market operations. And the third one is a policy that's not really used really ever at all, but it would be the discount rate. And the discount rate is basically interest rates on short-term loans by commercial banks to the Fed. Now, like I mentioned earlier, the Fed requires all banks to meet a certain, may require all banks to meet a certain requirement for their holdings. It may be 10%, it may be 20%, but let's just say it's 20% in this case. But let's just say there's a bank that's not meeting the reserve requirement of 20%. Now, it may be easy for that bank to go borrow from other banks, but the Fed is known as the lender of last resort, and they're able to lend to that bank at a much cheaper rate. But because they're able to lend to that bank at a much cheaper rate, they're getting cheap money that they're able to loan to consumers or investors for a cheaper price. In a nutshell, that's pretty much it. We can get into some more details of the discount rate in class this week. But generally speaking, for the discount rate, all it is just interest rates on short-term loans for commercial banks to the Federal Reserve, because they may not be meeting their reserve requirement, which violates a federal law. So to stay in tune with that federal law, what they'll do is they'll, instead of borrowing from other commercial banks at a higher rate, they'll borrow from the Federal Reserve at a much lower interest rate, which in turn they can use that lower interest rate to keep rates down, to let's say make loans to consumers, investors, and maybe other corporations and businesses. So right now, that's going to conclude the first video. The next video, we're going to talk a little bit about the difference between debts and deficits. And I thought it was very pertinent to go over, because I think this is one area that a lot of people get confused, the difference between debts and deficits, because in some ways they almost sound the same. If there's a shortage of something that you have, you would most intuitively think that this is a deficit. But in the next video, I'm going to explain the difference. So I'll see you in a few minutes.